All right, real quick while we wait for this to get started, type in where you're joining us from today. So again, always fun to see where everybody's tuning in from. New York City, Florida, France, St. Louis, Atlanta, Pensacola, Chicago. I'm actually headed up to Chicago tomorrow. Russ, Indonesia, Vero Beach, Calgary, Chicago, Sweden, Calhoun, Georgia, Ecuador, New York City, Dublin. All right, very cool, very cool. Well, here's a, yeah, that's right. Amar's giving me a hard time. I always show this map, and you know we've got people just about everywhere except for Greenland. We can never find that trader in Greenland, but we'll get him one day. So if we have to send Amar or somebody else there just to do that. Well, real quick, I'm going to play a quick video, tell you a little bit about the TradingPub, and then I'll turn things over to Amar to get started. So we appreciate you guys taking the time to be here today for sure. We're going to do our best to make sure it's a good class for you. And so we are recording, and at the probably later tonight or early tomorrow, we'll send a copy of the recording out to everyone as soon as we get it uploaded. But give you guys a second to watch. All right, well, very cool. Well, we appreciate you guys joining us for today's TradingPub event. Looks like we've got a great crowd in the room with over 360 people from all over the globe. Everybody should see a copy of the PowerPoint. It says the most important indicator. If for some reason you are not seeing the PowerPoint, you can try hitting F5. So again, if for some reason you are not seeing the PowerPoint, you can hit F5. Real quick before I turn things over to Amar, who's going to be giving you guys the education today, just like to give you a little background of actually how I came across Amar and came across PivotFarm. I guess, Amar, it was about 2 years ago, I actually stumbled across PivotFarm on the web and signed up for it. And I got an email back shortly after signing up for it from Amar, and kind of began talking about it. And basically started using it. You know, I was actually a paying subscriber, and used it each day in several of the different markets I trade, and continue to have access to the tool up to today as well. So again, you know, Amar does a great job. He's been on here before. I think the last time he was on here with PivotFarm was probably about a year ago or so. And so again, Amar, I appreciate you taking time out of your day. He's based out of London, so he's definitely staying up late. I know he's got a young son. So he's probably used to being up late at night. But Amar, thanks again for being with us, and I'll turn things over to you.
Hey Morgan, thank you for that great introduction. You'll probably hear my young son screaming into the room at some point. I kind of let him run wild in the house, so pretty soon, at some point throughout the webinar, he'll be coming in and saying hi to everyone. Guys, I'm in London right now, and I don't know if any of you guys are from the UK. If you're from the UK, give me a yes, but the snow is looking absolutely amazing. We've just kind of had this surprise snowstorm, and it's just It's pretty crazy wild here. Can everyone hear me okay? Just had someone say there's a bit of static. Okay, let me just turn the audio down a little bit. How's that, guys? Is that better? It's because of this amazing, super high-powered microphone that I've got. It's too much for the internet. The internet just can't handle it. Okay, great stuff. So everyone's saying it's better. Good stuff. No PowerPoint. If you're not seeing a PowerPoint, please press F5 and you will be able to see it very, very shortly. Okay. All right, guys, before we get started, is the usual disclaimer. Past performance is not indicative of future results, and whenever you're trading, please do be careful. All right, let me tell you a little bit about us, what we do, who we are, and who I am. Basically, I'm a trader and market analyst. Trading is what I do for a living. It's pretty much what I've done since I left school. I've always been, an entrepreneur. I've always had small businesses ever since I was 13 years old, and trading for me was an extension of basically being an entrepreneur. It's one of the few businesses where you can work for yourself, make your own hours. It's a very, very, very powerful business. So pretty much from an early age, I was interested in trading, and after I left university, trading is what I did. I've worked as an analyst, providing reports and research to companies as well, and I've also been working with prop firms, in my time as well. I've been supplying my research, which is PivotFarm, to lots of prop firms and major funds in the UK and the US. Recently, we've actually been nominated for the Technical Analyst Awards of 2013 for Best Specialist Research. I'm up against Citigroup and a few other major banks, which is quite scary, but hopefully, it should be a good day for us when the award ceremony happens. What we essentially do at PivotFarm is provide support and resistance research that we call the power zones, and we also provide a data sheet with a variety of analysis for traders. Now, guys, before we get into the nitty-gritty of today's presentation, I want you to tell me a little bit about you guys. What markets do you trade? So, are there any FX traders in here? Any guys trade the euro, the S&P, futures? What markets interest you? I just want to get a gauge of the kind of traders we've got in the room. So we've got some FX guys, options, equities, S&P futures. Wow, that's a good mix of people. A very, very diverse mix of traders. Excellent. Bonds, Forex. Very good. Very, very good. All right, so let's kind of dive into this. Now, as I'm sure you guys know, trading is a game of probability. Every trading idea, everything that you do as a trader, pretty much most things in life have some element of probability. And the key as a trader is the understanding that whenever you conceptualize a trade idea, your odds are even. Right? When you conceptualize the trade idea, you have a 50-50 odds because the market can either go up or it can go down. If you're deciding in your mind to take a short position, at that point of conception of the idea, you have 50-50 odds. But literally, as soon as you pull the trigger, the odds turn against you. Right? They turn against you because of the spread. They turn against you because of commissions and a variety of other reasons. Your job as a trader, the most important thing that you can do as a trader is work out ways and methods to put the odds back in your favor. So now, guys, this is another question to the group. What adds probability to your trade? What can you do as a trader to increase your probabilities, to refine your edge? Because trading is totally a game of probability. So type, what can you as a trader do to put the edge in your favor? What adds probability to your trade? Because what we're looking for as traders is these little slivers of probability that add to our edge. Because as soon as we pull the trigger, let's just say our advantage goes down to 47%. As soon as you pull the trigger, because of these market factors, your job is to put the odds back in your favor. Does that concept make sense, guys? Give me some yeses in the room. Does it make sense that your job as a trader is put the odds back in your favor? Excellent. Now, here's some examples of what you can do, and I saw some amazing examples from everyone here in the group. Some people mentioned trading with the trend. They mentioned your risk to reward ratio, analyzing volume, P-wall, and to mention a really good one, which is kidnap Bernanke. That's a really good idea. That's an edge. That's what I'm talking about. And then trading with the trend, lots of trading with the trend, support and resistance analysis. It's always some form of analysis. Excellent, guys. So great stuff. So what you have to understand as a trader is that our job is to work out the little things that we can do every single day to add an edge to our trading. Now, this is going to sound a little bit strange, but things like your morning routine. I have a mantra that I read every single day that I've read pretty much, I don't know, for the last 7 years, and I've read it every single trading day. It's 25 points that I pay attention to remind myself. That for me is something that adds probability to my trading because I'm reminding myself of what's important. I'm reminding myself of my rules. Do you work out before you trade? These types of things, they sound really silly. It sounds insignificant almost, but they add a small sliver of probability to your trading edge. And our goal as a trader is to add to our trading edge. So all of the things that you guys mentioned, trading with your plan, all of these things are important, but there's so many external factors as well, like how you're feeling that day, your mood, these types of things. You've got to do everything you possibly can to know when you trade your best, when you have your greatest edge, and make sure that you try to recreate those conditions every single day. Does that make sense, guys? Give me some yeses. Give me some yeses. Excellent. Lots of yeses coming through. Great stuff. Okay, so let's bring things back a little bit. This presentation is all about support and resistance because to me support and resistance is one of the most powerful indicators that you can have. It's the most important thing to pay attention to. So what exactly is support and resistance? Well, the classical definition is where supply overtakes demand, this is described as resistance, and when demand overtakes supply, this is described as support. I like to go a little bit further, and what I say is that support and resistance is a technical interpretation of price based upon specific methodologies. These methods provide an indication of market dynamics in terms of supply and demand. When supply overtakes demand, this is described as resistance, and when demand overtakes supply, this is support. The supply and demand dynamic can be interpreted or predicted by methods that can be either proactive or reactive. Now, guys, these are two incredibly important words in my philosophy and in the way that I look at trading analysis. Proactive or reactive. Very, very powerful two words. Now, what do I mean by these two words? Reactive information is support and resistance information based upon direct price and volume action. Direct price and volume action. So it's the major peaks and troughs that you actually see on your chart. Proactive support and resistance is information based upon predictive calculations derived from price and volume action. Okay, so reactive information based upon direct price and volume. Proactive information is based upon predictive calculations that are derived from price and volume action. Do those two set paragraphs make sense? Give me some yeses, guys. Does the difference between these two make sense to you? Okay, so direct volume action, direct price and volume action, and predictive calculations. Now, guys, I want you to tell me the methods that you employ. Type into the text chat. I've got a list here. Type into the text chat. Let me know which of these you employ. So proactive support and resistance is things like Fibonacci, calculated pivots, Elliott wave, moving averages, market profile, trend lines. All of these methodologies, they use what price actually did, and then it's some kind of mathematical derivative of price action that gives you the numbers for Fibonacci, that gives you the numbers for Elliott wave. Does that make sense, guys? Give me some. Wow, there's a lot of people in this room today. Okay, so a lot of people using moving averages, pivots. Great stuff, guys. Reactive support and resistance is the flip side of this coin. It's volume profile, price swing highs and lows, initial balance, the open gaps, the open high, low, close, all these types of things. So these are the two kind of sides of the equation in terms of analysis. You've got proactive, you've got reactive, you've got mathematically derived, and you've got, price and volume derived. So these are the two distinctions. And as a trader, it's important to look at both. And I'm going to be talking about how I look at both and the methods that I employ and how I do this research. And I'm hoping that it gives you lots of great ideas, guys, that you can take away, that you can apply to your own trading. So before we get into the rest of the presentation, I just want to do a quick illustration of support and resistance just to make sure everyone has a basic understanding of it. So we've got price hitting a resistance area here. We see some supply coming to the market, taking us lower. The price finds support here. Demand comes in. We double bottom. And the market then moves higher back up to this resistance area here. So this is my little pet dinosaur, my support and resistance dinosaur, which I hope everyone likes. We'll call him Neddy. There we go. Okay, so this is my this is basically a quick description of support and resistance. You've got major highs, price finding support, demand coming into the market, taking us high. Does that make sense, guys? Give me some yeses. Very straightforward, very simple. This is the basic concept. All right, guys. A key feature of support and resistance is role reversal. This is a very, very fundamental and simple concept, but this is what support and resistance is all about. It's what was once support becomes resistance, and what was once resistance becomes support. And the key thing is when you're applying support and resistance, you've got to have a setup. You've got to have a methodology that you employ to look for a trigger, and the support and resistance analysis as the extra layer of probability. Remember, guys, we talked about these slivers of probability, these layers of probability. You've got to be able to find ways to add more, and support and resistance is a massive sliver of probability. So what I'm going to do now, I'm going to break down my methodology. I'm going to break down the method that I use every single day to put together the research that I supply to hundreds of traders, professional traders, guys in institutions, individual traders. These are people that use our research, use my research, and I'm going to break down my method. I'm going to go through every major detail of what we do. And the method breaks down into three main parts. And we're going to go through these parts one by one. Now, we're going to go through the first part, which is technical confluence. Technical confluence. Now, technical confluence is basically using multiple support and resistance methodology. So earlier on we talked about reactive support and resistance, we talked about proactive support and resistance, and I listed a bunch of methods that are examples of both. Well, technical confluence is basically combining these different approaches, combining reactive approaches and proactive approaches and putting them together. You're putting Elliott wave and Fibonacci and volume profile and lots of these different methods together. And you're cross-referencing, you're comparing these methods to find high probability reversal areas. So conceptually, guys, does that make sense? Does that make sense to you? Give me some yeses. Combining multiple forms of technical analysis, putting them together. Now, I'm going to show you some examples of what I'm talking about. So how does this method work? Well, we've got a price chart here. And what we do is actually look at multiple time frames. So we look at anything from a monthly down to a 5-minute chart. So the chart that you see here, the blue lines, are major peaks and troughs in price swing highs and lows. So you've got major price swing high there. And some of these lines might not make sense because they're from a higher time frame. But these are the major peaks and troughs in price that you see on your chart. So we've got those drawn up. Next, now we're going to get things start getting interesting. We're going to start adding volume profile. Volume profile is major peaks and troughs in volume at price. So these red lines indicate areas of high and low volume. Both high and low volume are worth paying attention to. So these are drawn in here. So we've got those drawn in. Next into the mix, we're going to throw in calculated pivots. And this is where things start getting really spaghettified because there's quite a few calculated pivot methodologies. Can you guys name a few? Anyone here heard of Woody's? Anyone heard of floor pivots? Type into the text chat if you know these methods or if you can think of any more. Demark, Camarilla. There's lots of methods out there. What we do at this point is combine multiple forms of pivots. The classic pivot, absolutely, Edward. We combine multiple forms of pivots, but I don't use one single method. I statistically weight all of these methods, but I look for pivot clusters. I look for areas where lots of pivot methodologies are coming together. So this area here, that's a pivot cluster. This area here, that's a pivot cluster because you've got major pivot levels coming together and clustering. Does that make sense, guys? So any of you guys that use pivot points, I'm sure you know what I'm talking about here. All right, excellent. You guys are with me. Good stuff. Now, next into the mix, we're going to throw in these lovely pink lines that are derived from Elliott waves. So you've got these major levels and areas of importance to an Elliottician, again from multiple time frames drawn in here. Now, I hope you see where I'm going with this. So the next thing that we're going to do is add Fibonacci. So these green lines that you see here, they are areas where multiple Fibonacci levels are confirming. These are Fibonacci clusters, again, for multiple time frames. So we're talking monthly all the way down to a 5-minute time frame. These are areas where multiple retracements and extensions are coming together, and these are where the real Fibonacci clusters are, where lots of Fib levels are coming together across multiple time frames and confirming each other. Okay, guys? And what you'll start to notice is there's quite a few areas where multiple methods come together. There's quite a few areas where Elliott wave and Fib levels and major pricing highs and lows, where they come together. Can everyone see that? Give me some yeses. Can you see the importance of that? Can you see the importance of having multiple forms of analysis confirming each other, multiple forms of analysis clustering, multiple forms of analysis coming together? Excellent, guys. Good to see you with me. And there's quite a few other methods that we employ, like moving averages and open high-low closes and all sorts of things. But the thing about this is, this is technical confluence. This is combining multiple forms of analysis. This is a heck of a lot of work, and it's crazy. You're probably thinking of this, and man, this is paralysis by analysis. There's just so many lines. There's so much to look at. There is method in the madness. So stick with me, and when we get into part 2 and part 3, it will all start making sense. But I'm glad everyone's with me so far. Which is great to see. Except Lynn Higginbottom, who said no. But hopefully Lynn will be able to turn that around. So everyone's with me. You're combining multiple forms of technical analysis. You're combining multiple forms, multiple approaches together, and you've got these areas where lots of methods are coming together. This is key. This is important. This is called technical confluence. Now we're going to move on to part 2. This is where things start getting interesting, because the technical confluence is basically giving us a raw lay of the land. Intermarket correlation is the next most powerful stuff. And guys, who's heard of intermarket correlation? Give me some yeses in the room. Have you heard of intermarket correlation? Chalmers, Jim, oh wow, loads of people have. And there's a few people saying no. Intermarket correlation is one of the most powerful trading ideas, trading methodologies, ways of looking at the market. And what it does, what you do as a correlation expert or someone that pays attention to correlations, you're looking for various markets that move together, that move in tandem. Is there a correlation between market X and market Y? Because when you've got multiple markets moving together, the strength of a move is exaggerated, it's amplified. So market correlation is incredibly important, and if you're in an environment where you see correlated markets that are moving together, and for some short period of time they stop moving together, most traders that pay attention to correlation, they would step out of the market because they know that any move they trade is unlikely to be sustained. right? Because you want your winners to run, and winners run when there is market correlation. Does that make sense, guys? I don't have a lot of time to go into great depth with that, but I just wanted to give you a quick overview. Okay, great stuff. Everyone's with me. So we're in a global marketplace. And a global marketplace means that there's lots of instruments that trade together, that have correlations with each other. And because we're in the information age, lots of the data for these markets is shared across the world within milliseconds. Within milliseconds, the changes in price are filtering around the world. So markets tend to move in tandem, and markets like the S&P, the Nasdaq, the Dow, they all with each other share a correlation consistently of over 85%, if not more, if not higher. There's been times where I've seen correlations from the S&P, the Nasdaq, and the Dow to be over 95%. So that means that pretty much every movement that you see in those two markets is almost identical. And that's a very, very powerful thing, because a correlated market, it gives you more probability for profit. Remember, guys, everything that we're talking about is about adding slivers of probability. Does that make sense, guys? Slivers of probability, small amounts of probability that stack up in your favor. That is what you do as a trader. That is our sole goal, stacking probability in our favor. All right, guys, so I want to give you an example now of what I'm talking about. We've got chart A and chart B. Chart A, I believe, is the S&P. Chart B on the right-hand side is the Nasdaq. What you see in those charts are technical confluence areas. You know the multiple approaches that we went through earlier on, and we drew the multicolored lines. You're seeing these lines on the chart. Now, what we're going to do, and you're going to do this with me, what we're going to do is compare these two highly correlated markets, and we're going to create pairs. We're going to create pairs. Which levels, which technical confluence areas pair with the other markets' confluence areas? So does confluence area 1, does that correlate with D? Does 2 correlate with E? What are the correlations? So type into the text chat. Alex is straight in with 1A. Good stuff. And Jellybean 3D. And Esteban 2B. Excellent. Excellent, guys. So it's 1A. Let's do that now. And this is a really simple task. I'm sure everyone agrees that wasn't too mentally demanding or taxing. Everyone knows what we're talking about. Everyone knows what we're on about. Then you've got 2 and B. And then you've got 3 and D. So these are the major correlation areas. Now, what we would do, remember the technical confluence was combining multiple forms of analysis. Our job as a trader is to increase our probabilities. What we would do, this is the second layer of probability. So technical confluence is layer 1, intermarket correlation is layer 2. By looking at technical confluence areas that are correlated with another market, we can increase our probability. This helps us to eliminate confluence area C and confluence area E. Does that make sense, guys? Give me some yeses. Give me some yeses if you want. I want to see a sea of yeses, a sea of Ys on this chart. Excellent. Everyone's with me. Everyone's with me. Does the concept of this, does it resonate? Is it something that's important? Hey, lots of Ys coming through. Excellent. This is the main thing. Our job is to keep stacking those probabilities. When you combine technical confluence in and of itself is a great edge. Then when you add the intermarket correlation, you're refining that edge even further. And it's helping you sift through the rubble to find only the best, most probable areas. Now, guys, this is where we. Oh, Bob M definitely gets it. This is where the rubber meets the road. This is the most powerful and most interesting part of what we do here. This is the next step, and this is where I apply statistical analysis to my trading and to my analysis. Now, I go deep. I'm very much the kind of person that spends a lot of time researching. I spend more time in my trading day researching than I do actually trading. which is probably an interesting thing for most guys. I spend more time researching than I do actually trading. I spend a maximum of 90 minutes a day in front of my charts trading. Maximum. Most days I'm done within 30 minutes, but I spend a maximum of 90 minutes. I probably spend at least 2 hours, if not 3 hours a day doing my research, refining my edge, stacking my probabilities, and giving myself the best possible chance of making a living that day. Does that make sense, guys? This is what we do as traders. It's all about refining your edge. Most of your work is done before you start even trading. Trading is just when you go to pick up your money. That's all trading is. The work is in the research. It's in looking back at previous trades. It's in analyzing the market. That's where your work is. But anyway, let's continue on with the presentation. The market, as you know, as I'm sure you know, moves through various phases. Now, on a high level, as the theory goes, these phases are accumulation, markup, distribution, markdown, and back into accumulation. So this is a cyclical market, up and down, and you see this across multiple time frames. Whether you're going from monthly to a 5-minute chart, this is the oscillations of the market, as it were, and how the market moves. What I found in my research is that, and this is going to sound really odd to you guys, what I found in my research is, earlier on we talked about technical analysis and we talked about lots of different technical analysis methods. And I'm sure there's lots of methods here that everyone uses. I found nothing works. I found that there is no one single method that consistently works. Not fibs, not Elliott wave, not support resistance high level. There's nothing. There is no one single method that works. And anything that you guys will name, I will tell you it won't work. Does that even make sense? There is no one single method that works. Now, what I've found and what I've been doing is that in specific market environments, sometimes these methods have an edge. I found that in an accumulation environment, volume profile works exceptionally well, but Fibonacci not so much. I found in a markup environment that Fibonacci works really, really well and other methods don't. And what's key to remember here is the market environment. There is no one single method that consistently works. There is no one single method that works all the time. In different environments, they work. If you've got the right market environment, if you're in an accumulation environment and using the right techniques, they will work. That's why I'm sure everyone here has experienced something like this, where you've developed, and trading methods and systems are the same. Trading methods and systems are the same. You develop a trading method, that trading method works really, really well for a couple of months, a few months, and then suddenly it falls apart. Nothing's changed. You're still using the same, same edge. You're still following the method to the letter. The market's changed. The market's changed. The market's evolved, and your system, your method is not evolving with the market. Does that make sense, guys? I know this is going to go against what every guru has told you when they're trying to sell you their, fib indicator or whatever it might be, or their method that does X, Y, Z. There is nothing that works. There is not one entry method that consistently works. There is nothing that consistently works. There's just nothing, because the market changes so much. And think of these last 5 or 6 years. How much has the market changed? In 2007, 2008, we had ridiculous volatility. We were seeing 1-minute candles on the S&P that were 10 points. And now we've gone back to such, these last few weeks at least, up until relatively recently, the volatility in the S&P was so low, we were lucky to see 15-point or 10-point ranges. We were seeing 1-minute candles that were 10 points. See, this is the thing. I don't want people to get me wrong. Technical analysis does work, but nothing consistently works. Nothing works in every environment. I don't know if you guys have heard of the turtle traders. Have you come across this experiment called the turtle traders? Okay, it was just to kind of go over it for some of you guys. There was a famous trader in the 80s. I can't remember his name now. It's escaping me. But he made money for decades. In the 70s and 80s, he was a very, very wealthy man. And what he believed was that the turtle methodology, the method that he created, it could be taught to anyone. And Steve got it, Richard Dennis. Um, what he believed that the methodology that he was employing could be taught to the average person of average intelligence, and they could make money in the market. And he trained up, I believe it was 20 people, and taught them this methodology, gave them all $1 million to trade with, and they made money. They made money. Now, if you use that exact same method over the last 15 to 20 years, you would have lost money, hand over fist. This is a method that worked for decades. You would have lost money, you would have been destroyed. This is a guy, a seasoned market veteran who, had so much respect in the industry, who was so well known in the industry. Exactly, the complete tail trader. It's a very, very famous study. This is what I'm talking about. There's no one consistent method that works. There's nothing that works consistently. There's nothing that works day in, day out. As a trader, when I mentioned that I spend most of my time researching, what I mean by that is that I spend most of my time making sure that I can adapt to the market, making sure that I know every beat, every pulse, every movement of the market, and I have an understanding and context of what's going on, how the market's evolving, how the market's changing, and how I'm going to change, how I'm going to adapt. Does that make sense, guys? Give me some yeses. Give me some yeses. I know there's a lot of die-hard technical analysis, the greatest thing ever invented people in here, but you've got to open your minds to the fact that there's a reason why apparently 90% of people fail in trading. There's a reason why, because it's difficult to consistently adapt. That's the hardest part of trading. It's psychology and consistent adaptation. Those are the two hardest parts of trading. Okay, so all right, I've kind of digressed from my presentation, but I'll get back into it. So as I was saying, the market moves through various phases, and in each of these phases, I found that there's, some methods work and other methods don't. And what I've done is I've broken the market down into various emotions or psychologies or phases, as you could describe it. Personalities, that's the best word. Various market personalities. Is the market bullish or bearish? Are we in a trending environment, a ranging environment, a high volatility environment, a low volatility environment, and various combinations of all of these? And all of these different environments have different methods that work at any given point in time. So what I do, and guys, really pay attention to what I'm saying now, because this is, I don't think I've made the best possible slide to explain this, but really pay attention because this is an important point. What I do now is statistically weight each of those technical analysis methods that we talked about earlier on. I statistically weight them. Let's just say it's from 1 to 10. It's from 1 to 10. So in this environment, which is an accumulation environment and it's low volatility and the market is ranging, this is likely to be, these 10 methods are the one that will work. So the top 3 are, I don't know, volume profile, pricing highs and lows, yada, yada, yada. I give them each a statistical weighting as to their success in each environment. Does that make sense, guys? This is probably the most difficult aspect of what I do for people to understand. If you can understand this, you'll get it. You'll get everything else. So getting some yeses. Okay, excellent. So I weight these. I basically model these methods. I've told, I've programmed into a computer what these methods look like. How to draw a fib, how to draw all these types of things. And it's historically looks at these methods and scores them. It gives them a rating in terms of, how successful they are in a given market environment. And I use these to create market personalities. Because if I know, and a market personality is much like a human personality. Like when you're happy, you're displaying certain characteristics. You're more fun to be around, you're laughing more, you're more jovial, you have a more optimistic view of life. These are the characteristics of a happy person, right? That makes sense, right, guys? Give me some yeses. Give me some yeses. So, okay, excellent. So everyone's with me there. So the market is exactly the same. The market has certain characteristics, right? The level of the VIX, the tick, the trend, these market internals. These pieces of information give you information about the market's personality. Because if you're seeing certain levels in the VIX, certain levels in the tick, you're seeing certain ATRs, which is average true range, and that is defining personality X. And if you're seeing a variation of those methods, of those levels, that's defining personality Y. Does that make sense, guys? Give me some yeses. So these different personalities each have in methods that work best in their environments. They all have methods that work best in their environment. And Richard, is exactly how I described. You would look at how the market's moving. You would look at where the market is relative to certain to where it was in the past. You would look at the certain levels on the VIX. You would look at all these types of these market metrics that would define the personality. Does that make sense, Richard? Richard is asking, how do you determine the market phase? It's the exact same principle. You're just basically analyzing what the market's doing, and you're defining its personality. So the key thing is, guys, the key thing is what I do and how I put my research together is one word: evolution. Success in the markets is about consistent adaptation. It's about consistent evolution and adapting to the market. Does that make sense, guys? Do you understand why that's so important? Give me some yeses. Do you understand why that's so important? I hope I've made that point very, very clear. And just like Charles just said, evolve or die. Evolve or die. And perfect example for everyone has heard of floor traders, right? These guys that used to work in the pits, and these guys made ridiculous money. Some of my friends are floor traders. They're ex-life floor traders, which is the floor in the UK. And since the market's become electronic, they can't make a living. They didn't adapt. They didn't evolve. The methods that they used and employed in that environment just don't work now. Yeah? Does that make sense, guys? Give me some yeses. I know I'm asking you a lot of questions today, but I want to make sure you get this, because this philosophy, this way of looking at your trading, it will influence everything you do, because you've got a method that you employ right now. It might be just one single method. You've got to constantly be looking at the market. You've got to make sure that you're adapting to it. You've got to make sure that you're changing with the market, with what the market's doing. Hi, Kang. We're going to try and save the questions to the end, and I know everyone has questions here. But Kai Wang asked a really good question. By weighting, do you mean you rate the methods? Absolutely. I rate the methods. I rate them in any given environment to see how successful they are and what I should be applying. Okay, guys, we're going to try and save all the questions to the end, though. So once you've done all that research, what you end up with is what I call the power zones, and these are the red zones that you would appear on your charts and what you would draw up. So guys, how do the power zones work? How does my research work? How does support and resistance analysis work? If you wanted to do this yourself, what's the power? And I hope I don't even need to go through this list, but when I'm going through everything, I want you to give me yeses in the room to say that you got this. Say that you got that particular concept. So technical confluence. Did everyone get that? That's combining multiple forms of technical analysis, combining them together, and looking for multiple methods to confirm each other in a particular area. Right? This gives you visibility in the market, because what you're doing is you're analyzing different groups of traders, because there's going to be groups of Fibonacci traders, groups of Elliott wave traders, groups of market profile traders. All of these guys are looking at certain levels. You're grouping these people together. You're grouping the Elliott wave guys with the Fib guys, with the market profile guys. You're grouping these guys together, and you're looking at the market holistically. Very, very powerful. Very, very powerful. Intermarket correlation. Intermarket correlation, guys. Did you understand that? Where you compare highly correlated markets, you compare them, and you look for them to confirm the technical confluence areas. You confirm the confluence areas. Richard, believe it or not, I do this manually. There's some bits that are the statistical bits is computerized, but the actual work of putting these charts together, I do that manually because that keeps me sharp. It keeps me in tune with the market, and I don't want a computer doing my thinking for me. So, that's one thing. Then there's the last thing that I call market sync. That's my cheesy little buzzword for it. And that's statistics. It's applying this layer of analysis where you're statistically weighting each of these methods. You statistically weighting them based upon how they're doing in particular market environments. And the environment that we're in right now, how well has this type of analysis done in similar environments in the past? Because everything's cyclical, guys. The environment we're seeing now happened, X years ago, and it just keeps going round and round and round and round and round. Things keep repeating because the markets are a summation of human psychology, and human psychology is limited. You're just going to see the same things over and over and over and over again. We're going to see crashes every few years. We're going to see the same, jubilance thereafter where everyone thinks it's never going to happen again. That's just how the markets are. It's psychology. This is what we're analyzing. Does that make sense, guys? Give me some yeses. So the key thing is you want to evolve. We want to adapt. We want to move with the market and what the market's doing at any given point in time, right? We want to adapt with the market. And, a lot of people poo-poo technical analysis, and you've kind of heard me poo-poo technical analysis where I've said that it doesn't consistently work. There's no one method that consistently works. But it's all about being on the right side of the self-fulfilling prophecy. Because the reason why some people say technical analysis works is because everyone's looking at that head and shoulders pattern, and that's why it works. Well, I don't care if that's true or not, because if that has statistical validity, I'm going to use that pattern, and I'm analyzing that pattern. All right, guys, I hope that makes a lot of sense for you. Now, this is where things start getting interesting. I want you to type into the text chat and tell me the method that you use. Just briefly describe your setup. Do you look for stochastic divergences? Do you look for MACDs? Do you look at candlestick patterns? What do you use to pull the trigger? What's your breakout? What do you use to pull the trigger? What method do you use to pull the trigger? So type into the text chat, guys, as many of you guys as possible. Yep, John asks his barber. That's a good one, John. I personally wouldn't do that. Okay, support resistance, candles, confluence. So you've all got methods that you employ. You look at candlestick patterns. You look at stochastics. You look at there's just a million different methods to pull the trigger. There's a million different methods for you to decide I'm entering here. The key thing is this. A lot of traders overuse indicators. They overuse, all of these methods out there and say that line X is going to cross this and blah, blah, blah is going to cross that and yada, yada, yada. My key principle in trading is that supply and demand analysis, it should be the core preparation for your trading day. So drawing up these levels, the method that we went through, drawing up those levels, getting the most high probability levels on my chart, that's the most important thing that I can do as a trader for myself. Indicators, they're the second part of that equation. They're an accessory for execution. They help me pull the trigger. Because remember, guys, remember this principle, and give me some yeses if you remember this. Trading is about stacking probability in your favor. Do you remember when we said that? Right? So as a trader, support and resistance is giving you X probability. It's helping you refine your edge in method X. You need a setup to get the best from support and resistance, because support and resistance plus a setup is refining your edge even more. Is refining your edge even more. Support and resistance plus a setup, but trading at the right time of day, that refines your edge even more. It's all about stacking these things up in your favor. So you just got a quick example here. And the reason why I asked you guys to list your methods is that you can use this type of analysis with anything, with any method. Any day trading method, candlesticks are, I've studied a lot of Steve Nissen's work. I've been to webinars. Candlesticks was one of the first things I learned as a trader. Um, and candlesticks and all these types of methods, they're setups. They're giving you an indication. Your job is to add probability, and that's where things like support and resistance come into play. Does that make sense, guys? Does that make sense? How I'm kind of describing stacking the probabilities in your favor? How I'm describing using support and resistance as a place to look for a setup. Right? You ignore the crap in between, but you look for setups to refine your edge that little bit more. Yeah, I hope that makes sense. These are really fundamental things that mold your psychology as a trader. Yeah, because our job as a trader, we don't want to overtrade. We want to limit our trades to the highest probability trades we can possibly take. And trading in the right place, having the right setup, all these types of things add to that edge. Give me some yeses, guys. You with me? It's all about adding to the edge. That's the one thing I want you to take home from this presentation today. So support and resistance can be used to refine and increase the probability of almost any day trading method. Any day trading method. And I've just got some quick examples here for you. We've got stochastics here so we've got price here making higher highs. We've got stochastics divergence, stochastics making lower highs, and you've got support. You've got a resistance area here from prior analysis, and the probability stack up, and the market's moving lower. You've got a greater edge. And there's another few examples here. These are just quick, just to help illustrate this point. You've got moving average crossover. You've got price hitting this resistance area, and then afterwards, you've got this moving average crossover, which is lagging a little bit, but it's confirming that area. It's confirming that trade, and it's helping you by you're avoiding all of this other mess. You've got crossovers here, you've got crossovers here. It's helping you avoid the crap. It's helping you avoid the rubbish in the market. And you've got another example. You've got RSI divergences. There's all sorts of methods that you can employ. But the key thing is, guys, is this making sense? What I'm talking about at this point, which is that you're basically using support and resistance to refine your edge, to keep you out of the rubbish, to help you avoid, the mess in the markets. Yeah, exactly, Mike. Look for a spike in the VIX. Look for spikes in the tick. Look for anything that you think gives you a level of probability, an edge that's in your favor. You should do. All right, guys. Now, guys, this is my research. This is what I supply to my traders every single day. It looks freaking scary. There's a lot of stuff on that, but it's very, very, very incredibly simple. It's very, very simple. I work with professional traders, and they want a lot of information. But the core of all of this is this area here. This is what everyone pays attention to: the confluence power zones. So I'm going to move on. I'm going to break this all down for you guys. This is the power zones matrix, and the key thing that you would pay attention to is just this. This is all that matters. This is all that matters to you as a trader. All that research, all the technical confluence zones, the intermarket correlation, the stats, it all boils down to this. Even this you don't have to pay attention to. Just this little red section here. These are the key levels to pay attention to, and this is what I urge people to look at. All right, guys, that's it. And then within the sheet, you've got lots of other information like volume profile. A lot of guys like this information. COT index. How many of you guys actually look at the Commitment of Traders report? The COT report. It's released weekly by the CFTC. Any of you guys at all? Give me some yeses. Okay, I think this is a very powerful bit of analysis, and I kind of collect this information, and I create like a COT index, and I look for the two groups to be opposite each other. So I look for commercial traders to be trading in one direction, large traders to be in the opposite extreme, and that for me gives me a bias. So that's something that's included within the data sheet as well. Then there's intermarket correlation. And guys, intermarket correlation, if you don't know about it, learn about it. It is awesome. And you've got any FX traders in here? I know a lot of people said they were interested in FX. This is only for FX, guys. On the FX data sheets, we actually have this retail trader ratio, and I basically collect from multiple brokerage firms about how their traders are positioned. And you'll notice in this it says 75% of traders are long, 24% are short. I look to be opposite them. So the reason why this is red is because my bias is to the short side, because 75% of retail traders are long. Does that make sense, guys? Does that make sense? This is, we're following the smart money. We're trying to avoid, and I'm just amazed at how consistent this is. It works so well. It works so when you find extremes, it's a very, very powerful thing. It's a very, very powerful thing. So, and also within the sheet, there's some video analysis, which is basically describing major news events. Guys, what's the value of this research? I hope that it's clear from what we've discussed today. I use a very exhaustive technical analysis confluence approach where I combine multiple forms of technical analysis. That in itself is amazing. It's great, great analysis. Then we've got market sync, where we're combining, we're combining all of that into market correlation and technical confluence work with statistics. We're combining the two together, and you can use it to augment and refine almost any day trading system. Any trading system. That's the key point, guys. Everything that you are using as a day trader, you can use this type of analysis to refine. All right, this is the one most powerful thing that we've touched on, psychology. Now, one of the things that really hurts traders is the fact that they overtrade. Because, when you're sitting in front of a screen for 6, 8, 10, 12, 20 hours a day, I've sat in front of a screen 20 hours a day. I did that in the past. The itchy trigger finger. You're constantly looking for the next trade, you're hunting, you're stalking. And every slight, dare that, every little bit of rustling you see in the bush, you think it's a dare and you shoot at it. Right, guys? Who's felt that? Who's felt that emotion as a trader where you're just itching to trade, you're itching to trade? It's just, I work on a trading floor in London, and it's just amazing how that emotion, that feeling is, whether you're a professional trader, whether you're just an average Joe trading a $500 account at home, everyone has that. Everyone has that emotion, and it's a very, very difficult thing to control. But if you're limiting where you're trading to major areas of probability, you have an edge. If you're limiting where you trade to major areas of probability, and you know that if the market's not hitting that area, I can't trade, that's powerful, guys. Give me a yes if you agree with me. Does that make sense? Absolutely. Great stuff. It makes you more focused. It makes you more focused because you know what you want to happen before you take your trade. You're much more confident as a trader. All right, guys, so this is our service. This is what we provide. It's the PivotFarm data sheet, which you see right here. Indicator, because traders, we're lazy, we don't like drawing levels on our charts. We provide an indicator for all of these platforms. All of these platforms will have those power zones, that little section here in red, they will have those levels drawn on their chart. Multi-charts, Sierra chart, MT4, NinjaTrader, TradeStation, eSignal, all of these platforms. And guys, what platforms do you use? Any NT traders, any eSignal guys in here, any Sierra chart? What do you use? Okay, excellent. Yeah, so we cover most of this platform. Thinkorswim is a pain in the butt. I have an indicator created for Thinkorswim, but it's just so much work to use it because Thinkorswim doesn't allow communication to a server, which is a pain in the butt for us. But we're going to be rolling out more platforms, in future, I hope. But yeah, these are the platforms we cover right now, and this is what I use. And Valerie asked, "What's my favorite platform?" I like NinjaTrader. I like them all actually because I have all of these platforms and more because I'm looking for ways to consistently refine my edge, and some of these platforms have different. I pay for a lot of platforms, um, and you know that's just something I do. I'm crazy like that. I'm always looking for that little thing to refine my edge. These are the markets we cover: the S&P, the Nasdaq, the Dow, the Russell, crude, gold. We've got the Euro stocks and the DAX in beta. And you know if you are looking to trade those, you just contact me. And we also have these forex markets that we cover. Oh, and I am scribbling all over this screen. Yeah, we do CL. So guys, if you just take a quick, let me trash this. These are the markets we cover. So CL, crude oil, TF. You know, take a good look. These are the markets that we cover. Now, guys, ECs, Siva, that's the 6E, right? We do have. You can use you can use the Euros research with the 6E and the pound research with the 6B. Okay, guys. I've got a great special offer for everyone attending today. You can get a 6-month subscription to a single market for 117. So on a monthly basis, that would work out to be around $300. So that's over 60% off, which I'm sure is a great saving for any of you guys that trade one market. And if you trade 12 markets, or the 12 markets we offer, or you just trade more than one, the 297 deal we have will be really great for you. So you've got 6 months at 60% off of 297, and that's a really good deal for you. These are the markets we cover again. You can sign up at pivotfarm.com/special. And guys, I will never ask anyone to use my research without trying it out first. So you got a week to try it out. And Garrett, it's 297 for 6 whole months, for the whole 6-month period. So if you're buying all 12 markets, it's 297 for that whole period. But no one is charged today. No one will be charged today. You've got a week to try it out, to see if it's for you, and that's it. Yeah, Liz, you're not even charged in the first week. So guys, if there's any questions, please type them into the text chat. Type away. Any questions you have throughout the presentation, I'm going to answer them now. Hi, Helen. Yeah, the same subscription can be used on eSignal, MT4, NinjaTrader. You can use it on all of the platforms. Diane, equities. We don't cover equities yet, but I plan to. That's something I'm working on now. But mainly E-minis. These are the markets we cover right now. These are the instruments we cover right now. Hi Gary, all indicators use the same time frame. You can use whatever time frame you want as long as it's a day trade time frame. The zones just literally appear on the chart. Hi Mahesh, what will this be in pounds? I guess for the all markets that's just under £200, and for 6 markets probably about £70. Hi Liz, the research is actually released ahead of the Asian session, so you can use it for the European market. What happens after 6 months? Randy, that's a good question. You keep this price. This is the price for the lifetime of your subscription. For the lifetime of your subscription. Okay, Eusebio, every presenter always mentions high probability trades. What are your numbers? 50%, 75%, 90%? Thanks. Now that's a very interesting question. Guys, I want to ask you a question. What would you consider to be high probability in trading? What kind of success rate would you consider to be high probability? So if you took 100 trades, how many of those trades would be winners? What would you consider a high probability of success? 75, 80%, 80%. Should I tell you what my success rate is? I am very happy when 37% of my trades are successful. chew on that for a second. I'm very happy when 37% of my trades are successful. That to me is amazing. That to me is excellent. 37%. So that means 37% of my trades are successful. So 37 out of 100. I focus on massive. I mean, I aim for a minimum of 1 to 5. So for my risk in that trade is 5 times smaller than any potential gain. That to me is what trading is all about. So I have a lot of break-even trades, mainly break-even trades. I have some losers. My losers are small, but my winners tend to be bigger. Does that make sense, guys? I know this sounds odd because everyone here is saying 80%, 70%. I don't know anyone that gets those kind of levels. I just don't. I've never that's got 80%, and I didn't believe him. I didn't believe the reports that he was showing me. But this is the thing, guys. You've got to me. You've got to. I'm sure there are people that do that. I'm sure there are people that have that level of success. I just don't. My success has been in letting winners run and cutting losers short. Yeah, letting winners run and cutting losers short. That's to me. This is counting scratch trades, because you're always gonna have. This is what it's all about. You've got to include all your trades. So that's me. And hearing that statistic, you'll probably think, what, this guy's not that successful a trader. 37%, that's rubbish. But guys, this is the kind of edge that real traders have. They don't. It's not massive. If you've got the right risk to reward, you will do well. That's what counts. Risk to reward is everything. Winning percentage is nothing. And I'll give you a prime example. I know of a trading method that has a 99% success rate. 99% of the time you have a 1 tick limit and a 100 tick stop. That's 99% successful. A 1 tick limit and a 100 tick stop. 99% successful, that trade. I hope that makes sense to you guys, if everyone understood that. Tom, what time frame do I trade? I trade pretty low. I use 1 minute charts of below range bars. I use range bars to kind of keep an eye on how the market's moving, and then in terms of execution, I kind of use maybe either a 1 minute or a range bar chart. It varies over time. Like if you had asked me the same question 3 years ago, even a year ago, I would have given you a slightly different answer, because evolution is evolution. You've got to evolve, you've got to adapt, you've got to change with the market. And if your stats are telling you that if you had done X instead of Y, you would have done better, that's the key thing. That's the key thing. So guys, this is what it's all about. This is what trading is all about. This is the name of the game. It's all about massive risk to reward. If there's a lot of people, I know of people that have success like 1-to-1 who have a 2-point stop and a 2-point limit, and they do okay. But the actual edge, you don't actually have an edge there. It's not actually 1-to-1. It's less than that, because when you bring in commissions and spread, the edge is against you. The edge is against you. That's just a fact. And slippage, the edge is against you. By having larger risk to rewards, I mean, I've tested having 3 tick stops and 100 tick limits. Just as an idea, like trade with the trend, have a 3 tick stop and a 100 tick limit, and I was quite amazed at how well it did. Obviously there's better strategies out there, but just because of the fact that you are, when you get a winner and you let that winner run, you make money. And I've experimented with something else that's kind of cool as well. Have you guys ever thought about how much time you spend in a trade? Have you ever thought about how much time you actually spend in a trade? How much time you spend in a trade? When I've analyzed because I work with a bunch of traders, and I've looked at their timing reports where you can see how long they spent in trade X versus trade Y. I found the guys that were losing money spent twice as long in losers as they did in winners, and the guys that was making money spent 2 to 3 times longer, if not more, in their winning trades than they did in their losing trades. Does that make sense, guys? Think about that. Think about that. If you're spending twice as long in a losing trade than you are in a winning trade, you're not letting your winners run. You're letting your losers run and cutting your winners short. Think about the time. Like when you get your timestamps from your trading records, think about that. Go through it. Make an Excel sheet and analyze the ratio of how long you spend in your winning trades versus how long you spend in your losing trades. That's a really powerful thing. I mean, I've actually developed a strategy just based around time. If I spend if the trade is in profit, the time spent in trade is 20 minutes. If the trade is in a losing position, it's maximum 5 minutes. I've experimented with things like that, and it works. It's interesting. It's simple. Does that make sense, guys? I know it sounds weird because no one really looks at trading in terms of time, but you got to remember when you're trading, you have two variables, two pieces of information. In fact, three. You have volume, you have price, and you have time. Everyone looks at price. Some people look at volume. Very few people look at time. Time is a powerful thing, in terms of your overall trading analysis. Now, guys, I'm sorry, I have a habit of digressing from the point, and I'm hoping the things I've been talking about give you guys some value. Randy, could you show some recent charts of the power zones? Randy, you've got a 7-day free trial. When you load up the power zones on your chart, you'll have a history of well over a year, so you can go through that yourself. I can cherry pick some charts and say, hey, look, I nailed this, I nailed that, but if you go through the history, you can test it all you want. Hi, Kai. Yeah, like I said, you can get the indicator, load it up in the charts, free trial, totally free trial. There's no pressure, free trial. No, you're not going to be charged. Just try it out, put it up in your charts, and see for yourself. Me showing you 1 day or 2 days, it's not going to make a difference. You're not going to learn anything from it. Moises, I hope I'm saying your name correctly. We do have the DAX futures. I do have the DAX futures, but it's not officially on the site yet. So if you sign up and you want the DAX, you've got to send me an email and I'll tell you the link for it. It's still in beta. Hey Valerie, I'm glad you enjoyed it. I'm glad you enjoyed it. Guys, I hope that you gained some CBO. Oh, how do you consider volumes in Forex? This isn't the only product that I have. I have something else that I created as well, and I get my volume data as a result of that product. So I collect it from because FX is decentralized. So I collect it from multiple brokerage firms, and I basically use interbank data, and I kind of make my own volume for FX to give. I appreciate you signing up. That's very, very kind of you. I see lots of you have already signed up, which is really, really good. Jellybean Jones. That's a name. That's a good name. All right, guys. Thank you very much. Thank you very much. All the markets we cover are listed there. Sign up for a trial. See if it's for you. Kick the tires. If it's not for you, it's not for you. But I'm sure everyone, I hope, please, everyone, tell me, did you learn from this presentation today? Are you taking something away? That's the most important thing to me. Are you taking something away that will help you in your trading? That's the key thing. There's lots of things that we can talk about, but I hope you guys have gained something. Excellent. Kai, one currency is one market. It's one instrument. All right, guys. Thank you so much for your time. Morgan, dude, as always, thank you for your help, and thank you for being part of the team. You are the man. And guys, you're so lucky to be here with TradingPub. It's such a great resource. He's always inviting great traders. It's a great place to be. It's a great place to learn. And Morgan, you the man. All right, guys, take care. Thank you so much for your time. Any questions, feel free to send us an email.
All right, great. Thank you very much, Amar. We appreciate you being here with us today, and I'm so glad to see that everybody learned a lot from the presentation. We'll get the recording posted on our website hopefully later tonight or early tomorrow morning, actually. You can click this link if you want to take advantage of the trial. I can tell you just from personal experience, because I found Amar as a paying member, of his service, still get the service to this day. So again, I think it's something that you will definitely appreciate and enjoy. And the thing that it really helps me with is just there's a lot of markets that Amar covers that I don't watch intently, but I trade from time to time. And so I can go into markets like the gold market or the crude market, something I'm not really well versed in trading every day, but might look for an opportunity a couple times a year and immediately see those areas. So I think that you guys will definitely enjoy it, and you have a week to try it out and make sure it's for you. So all right, everyone, we appreciate you guys being here. Our next event is going to be on Thursday, and it's Thursday afternoon on candlestick breakout strategies. So when we shut the room down, you'll have an opportunity to sign up for that. But if you want to write this link down, it's www.pivotfarm.com/special for the 50% offer. Thanks, Amar.